So, welcome to FX Street's monthly seminar. My name's Andrei Knight. I'm very pleased to be your guide and mentor, if I may, for the next couple of hours. This seminar is going to be split into two parts. For the first 2 hours, we're going to look at ways to cut your losses. We're going to try to understand where losses commonly come from and what we can do to minimize them, right? That's what we're all after. Part 2 later on, those of you that are premium members, we're going to go on to discuss ways to maximize your profits. Meaning now that we've sort of plugged the holes and we're sure the boat's not sinking, let's see what we can do to put a faster motor on it, right? And go even further. So that's the two parts. That's what we've got coming up today. I want to start out by asking you guys, what is the overall experience level in here? Can you guys kind of shoot me maybe on a scale of 1 to 5? 5 being you're an expert master trader with a few years of experience under your belt. 1, you're just getting started. Just kind of shoot me a number so I get an overall feeling where we're at. Okay. Okay, that gives me a pretty good feeling. So we're kind of all over. We've got some experts in here, perhaps looking to brush up on some of the basics, and also maybe you have a recurring problem in your trading. I will, by the way, leave some time at the end. If you guys know that you're having some recurring problems in your trading, go ahead and bring them up, and we'll see if there's a way we can find a solution to them. That's towards the end. I'll cover some of the most common ones in a moment. Maybe you'll already find yourself within that group. But if towards the end of the presentation you're experiencing a unique problem that I haven't covered yet, by all means let me know and we'll put our heads together, see if we can't come up with that. And if you're an overall beginner, well, great. You know what? You're in a fantastic place because we're going to cover some of the most common mistakes people make. And if we can save you from making them already, hey, you're going to start out ahead of the game. Okay, Jose, I saw your post, for example. You made 70% in March, and you gave 40% of it back in April. Hey, you know, you're still up 30%. That's great. But that actually happens fairly common. Risk goes up proportionally with reward, but we can do some steps to manage the risk, okay? A lot of times that happens because in order to get those really huge gains, people take on unnecessary risk or expose themselves to more risk than they have to. So we can look at ways to minimize the risk and hopefully keep the gains, if not necessarily that high, still high enough to be enjoyable for you. You'll notice a lot of the banks, I mean, they trade more like 5%, right? They're happy when they don't lose money. But the trick is they're able to do it consistently. Now, I'm not saying you have to go down from 70% to 5%. We will look at ways to maximize your gains first. But first, let's look at ways to minimize the risk. What do you guys think? And that's true. April isn't over yet. Maybe we can plug some of those holes, Jose, and maybe we can turn it around for you. There's still plenty of trading days left. And I agree with Len 100%. Education is absolutely important. That's the best way to improve performance. Even some of you 4s and 5s out there. It may seem like what I'm covering are some of the basics, but you know what? I learned a lot of the basics too, and whenever I hear somebody talking about them, I always pick up new things. There's always things that we've covered so much, we start taking them for granted. You know? So what do you guys think? What are some of the most common mistakes made or some of the most common things that lead to recurring losses out there? I just want to get a feeling for what you guys think they are, and then I'll let you know what I think they are. Absolutely, Boyke. Repetition? Absolutely. Okay, you guys hit on the first two right away. No stop loss and mental stop loss. Oftentimes they're the same. Lack of money management? Excellent. Looking at the charts too much? Could be. Could be bad money management, bad risk management? Absolutely. No stop loss? Excellent. Over trading, good one, good one. A lot of times those losses can just be cut down if we can find ways to minimize the trades, right? Cut out the bad ones and only take the good ones. Unclear market direction? Perhaps. That could well be, DB, but if the market direction is unclear, you shouldn't be trading. So that kind of leads into overtrading a little bit. Emotions, absolutely. Trader psychology, often overlooked. Undercapitalization and over-leverage. Perfect, CBJ. Absolutely right. Absolutely right. You guys are awesome. Okay. Hoping price will turn around, right? That kind of goes into no stops. Lack of mentorship. Absolutely, Leo. That's part of the reason I'm doing this today. And in general, why FX Street does things. I'm not the only good mentor on there. Absolutely, expose yourself to as much education and as many different viewpoints as possible. But also ongoing mentorship, okay? It's one thing to learn a theory or strategy. Keep coming back and keep working with the same mentors. Because once you know the strategy, it's something else entirely to have your own trades analyzed. You know, maybe you think you're doing everything right, but maybe there's one or two assumptions in there. So it's absolutely critical not only to learn a strategy, but to have your specific use of it reviewed on an ongoing basis. So absolutely, you guys hit a lot of the major ones. A mad person using mental stops. Absolutely, Boyke. When we start revenge trading, meaning we lost, right. Same thing, Leo. When we lost money and now we've got a vengeance against the market, we're going to show the market, we're going to win it all back and then some. Absolutely. That can cloud your thinking. That kind of falls into psychology. And absolutely, it'll lead to losses. I've never once made money trying to make it back in revenge. Usually what I do is after I have a string of a couple losses, sometimes even 2 or 3, that's all it takes for me, I'll stop trading that day. I'll just absolutely stop trading. I'll pick it up again tomorrow with a fresher head. And usually I'll do better. Doubling down on losses. Okay, you're getting into martingale type strategies. That's a more advanced money management strategy. Casinos love to teach it if that's any indication. Absolutely, doubling down on losses doesn't get you very far. If you're advanced and you know what you're doing, sometimes you can use an anti-martingale strategy. We'll discuss that a little bit in part 2 today to multiply your wins. But that's only after you have a track record of consistency and wins. We're going to look at much more reliable money management strategies first before we get into anything advanced like anti-martingale. But absolutely, a martingale strategy, I've never seen one win. And it's amazing how many expert advisors and automated trading systems out there use some variation of a martingale strategy. They all do great for a while, but sooner or later they kind of implode and blow up. Fatally to trust your system. Absolutely, Len. But trust in your system, it's kind of a double-edged sword. Trust in your system can only come from years of experience and thousands of trades spent trading it. A lot of people learn a system, and after a week or two, we start doubting it, and we think we can make it better by introducing little variables and variations to it. It's absolutely, trust comes from experience. And indicators, right. Sometimes even using all the wrong indicators in all the wrong times. Or too many of them and not knowing what each one does, Harley. Beautiful. You guys have a pretty good idea of this stuff. Well, I'm happy to say that today we're going to look at exactly all of the above and some ways I've come up with to stop exactly things like everything you've mentioned from getting in the way of your trading and introducing losses into your trading. I think you guys hit pretty much everything on my outline of topics. So kudos to you. You guys know what's causing the losses, so let's look at some ways to fix them. Okay? Giving up on a system too soon. Absolutely, Leo. And yes, keep it simple. Absolutely. You guys nailed most of the major ones, so let's look at ways we can minimize the impact of all those things on your trading. Let's start with psychology. Okay? Greed and fear, the two most common emotions out there, right? Greed and fear. Let's take a look on the chart. Do you guys see my pointer? No, absolutely not, Boyke. Absolutely not. I think I can still come up with some good ways to help you guys minimize the effects of everything you mentioned. You guys are aware of all the dangers and pitfalls out there. But obviously they're still biting into your trading here and there and affecting you, otherwise we wouldn't all be here. You know? I've had a pretty good 2007 and 2008's off to a pretty good start. My trading statistics are pretty good, but you know what? I still cover stuff like this all the time because you can always get better. So let's look at greed. An example of greed is something like this. Price is moving up. You see this big gap up. You get really excited now, right? Price is moving up, and you can't stand that people are making all this money without you, so you decide to buy right here. And, well, suddenly price starts moving down. That was an example of greed, by the way. Now price starts moving down. It's moving against you. Okay, you're getting really worried now. We've completely engulfed this first green candle, so you decide to close your position for a loss. That's fear. Okay? Now, price keeps moving down. You can't stand it. Now you're thinking you could be making money in the other direction, so you decide to go short right here. And price starts turning around and reversing against you. So this is just a simple example of greed and fear in play, right? Greed got you into this trade long after the train's already left the station. Fear got you out of that trade. Had you stayed in longer and had a reasonable stop, experience would show you that gaps typically close. So a good place for the stop would be at least beneath the gap. Had fear not gotten you out, perhaps this would have reversed and eventually gone your way. But certainly fear got you out, and then greed got you in the opposite direction. So that's just a little example of how greed and fear work. Obviously, there's lots of other ways. Overtrading can be an example of greed. Okay? Just that urgency to always be in the market, and if price moves without you, then you think you're missing something. As opposed to an experienced, disciplined trader, they usually set up their parameters and they sit back. Very rarely do I have to chase a trade. Usually you know your parameters and you sit back and you wait for the trade to come to you. That's the opposite of overtrading. Yes, it forces you to trade much less. One thing you guys missed, by the way, is that looking at too many currency pairs all at once, trying to be all over the market. That's also greed. And it's kind of fear. It's greed that something might happen without you, and you might miss out on some profit, and it's fear that if you don't watch all the charts at once, one of them might move and you won't notice it and you'll miss out on that move. I actually, in my own pro group, we have a pro group that meets every day and we take trades together. We did this experiment and I had all the students pick just one currency pair and trade only that currency pair for a month. A lot of them didn't have the discipline to do it. But the few students that really stuck with it and traded one currency pair and one currency pair only for the whole month, every single one of them, without exception, saw an increase in their trading performance. My own stats, looking back at 2007, I had most months saw a gain of 23 to 31%. My biggest drawdown was in May for a 5% drawdown. And overall win-to-loss ratio, I had about 77, actually not about, exactly 77% win. So that's statistics going back 2 years. That's what I happen to have handy. I didn't really start compiling 2008. I'd have to go back and look at the individual months. But 2006, 2007, that's what they look like. Hopefully that's good enough for you guys. I also have to be more conservative. Keep in mind, I can show you ways to get the 200 to 300% gains that people advertise. But that's going to be, we're going to cover some of that in session 2. But most of that are what I would term tricks, okay? They do expose you to a lot more risk, and you can easily blow up your account doing it. So it's only for more advanced traders. There are ways to do it, but certainly not without increasing risk. I manage other people's money. So my priorities are steady gains over really wild gunslinger gains, followed by equally wild gunslinger losses. My clients would never tolerate that. So I have to keep drawdown to a minimum, and I have to focus on smaller gains but steady gains. You know, everybody's Everybody's trading objectives are different. If you have no greed and fear, Andrew, you must be one of the rare few. Everybody experiences greed and fear. I experience greed and fear as well. The difference is I know some tricks for controlling them. Okay? But I still experience them, especially when you start trading with larger amounts of money. They're still there. It could be that maybe you're not as aware of their effects on you, but I think everybody experiences them to a certain extent. If you have no greed and fear, yeah, it could be maybe you're misreading some of the data that the market is giving you, or you're being tempted in by some of the false things, like in the example I showed you on the chart. We'll see. We'll take a look. I'll give you guys some of the most common mistakes and some of the most common ways of dealing with them, and you'll see where you find yourself within that, Andrew. What was that one pair, Mabel? Everybody got to pick their own. People picked maybe based on what they had experienced trading, or they picked maybe it was based on where they lived, so they were already familiar with the markets there, or maybe it was a country they always wanted to travel to, so it was a country that they wanted to take on, you know, studying the markets in that particular country and following the news. I let everybody pick their own favorite, but everybody could only pick one. It depends. If you're starting out, I would say maybe start with the majors, just because they're more straightforward. You're dealing with dollar crosses, so one half of the equation is always a fixed given. You can always follow the economy in the United States, and that's a fixed given, and then you just trade against the other country. And also the spread is lower. So maybe start on the majors if you're a beginner. If you're more experienced, certainly the crosses have the bigger moves, but they also have, each one has their own little unique characteristics and their own little subplots that you have to keep track of. So it certainly requires a slightly deeper knowledge of the market, but the rewards are slightly greater on the crosses. The spreads are proportionate also. So it depends. What was more picked? It was all over the board. It was kind of what I said. The beginners kind of stuck to the majors, and the more experienced guys stuck to the crosses. You know, everybody had their own favorites. Success or years? I'd say success is more important because everybody learns at a different pace. So for somebody, success might come after 1 or 2 months, consistency after 5 or 6. And for somebody else, it might take 2 to 3 years. Everybody's different. But I would say in terms of specifically consistency. I wouldn't measure success as in percent gain. I would measure it in consistency. Can you maintain a certain level of success from month to month? That's how I would measure it. I absolutely consider fundamentals, Boyke. I consider myself a discretionary trader. Okay? In that I use sometimes fundamentals, sometimes technicals, sometimes both, and also within my system. I don't really, in my pro group, I don't teach a set system. I'm not trying to create copycats that do exactly what I do. What I teach is a set of tools, individual tools, and a set of criteria for choosing the best tool for the job or the best situation when the market presents it. That's why I call myself discretionary. I might follow one rule, and then in the next trade, I'll totally ignore that rule and follow another one. It depends what the market's presenting me with. Okay, that's not the same as a reckless trader. Okay, I do have my criteria for choosing one tool over another or ignoring one tool over another. Being discretionary is not the same thing as being reckless. Just want to make that clear. I do trade the news. I don't spike chase. There's a difference, Dave. A lot of people spike chase and they get caught on the wrong side of it 50% of the time. And some of the time they get caught on the right side of it and it gives them a rush and encourages them to do it more often. I don't do that. Typically, I place a trade 5 to 15 minutes after the news. Once the dust settles, once everybody's digested the economic picture and what change that caused in the markets. So I trade after the spike. I measure the spike. I use fundamentals to let me know which direction we're likely to move, and I use technicals to measure the spike. And based on that, I can set some realistic targets. So I do trade the news, but I typically trade after the news. In some rare situations, by far the minority, I also trade before the news in the form of a straddle. But that has to be really specific reports meeting really specific criteria. Then I might trade before the news in the form of a straddle. But never ever do I trade during the news and spike chase. That's a gambler's game. Fundamentals are not just noise. Fundamentals are what move the market. If I was to sum it up, and this is a gross summary, obviously there's more to trading than this, but fundamentals tell you when something is likely to move and which direction it's likely to keep moving in, and then the technicals tell you how far. That's basically how I would break it down. So you have to use both. Using one over the other, you're only trading with half the picture. Okay? You need both. A lot of people also misinterpret technicals. Okay? You can throw a lot of studies on your chart to make it much more crowded, but basically there's no such thing as a magic number that says price did this, so now it's going to do this. This isn't numerology, and it's not voodoo. Okay, guys? The reason technicals work is because they are a way to quantify psychology. This is why I'm starting the presentation out today with a discussion of psychology, because people all too often overlook market psychology and they overlook their own psychology, when in reality, technicals are not magic numbers that predict the future. That's not what technicals are. If you trade using technicals that way, that could be part of the reason you're experiencing losses. Technicals are simply a way to measure past psychology and to give you an indication of what future psychology might look like, assuming the crowd stays the same and stays in the same mood. That's all technicals really are. They're based on mathematics, but they're a measurement of psychology, yours and the market's. Okay? You still need the fundamentals to tell you which direction the market's going and what mood the participants are in, but then the technicals can help you measure that and help you set some realistic stops and losses based upon that. But I think you absolutely need both. Do I believe in stop runs? I do, Boyke, because I've seen them. There's two different kinds, okay? There's the market players in general doing a stop run, and then there's your broker doing a stop run to shake out some of users. If you happen to see evidence of the latter, run and run fast, okay? Your broker should not be trading against you, nor should they be manipulating price feeds. If you see a difference between your broker's chart and another chart, and that difference happens to be spikes, watch out, your broker is being less than honest. You see that by spikes that are on your chart that you don't see on another broker's chart. You could be watching a free chart like those that are on daily effects. You could just have a demo account with another broker. That's good enough. When you're a pro, we typically use tools such as eSignal, which are actually a compilation from many different banks and brokers, rather than just one. And if I see that the price feed is starting to vary, and especially if I see pronounced spikes on my broker's chart that don't exist on eSignal, then I know something's fishy. Okay? It could be just a computer glitch. If it happens once or twice a year, it could be a computer glitch. That does happen. If it's constantly happening, or if it's happening always to your disadvantage, that's not a computer glitch. Now that being said, there are also general stop runs by the market as a whole. Okay? That's what leaves these long wicks, like the one I'm pointing to now. I call these kangaroo tails. Always look out for them. A kangaroo jumps in the direction opposite of its tail. Those of you from down under will appreciate that. But that's seriously what it is. Anytime you see a kangaroo tail, expect price to jump in the opposite direction. And that's exactly what causes this. Price goes down to an absolute extreme, usually before it reverses. It's got to test lower levels one more time to see if it's going to stick. And when it doesn't, when price goes down and instead of finding more bears, all it finds is more bulls who are waiting for a bargain to jump in and go long. That's what causes it. Okay? So a kangaroo tail can be indicative of a reversal, and that's kind of what people attribute to a stop loss. Are they deliberately running people's stops? Sometimes, yes, because they know that if they get people out of positions, that's going to free up more liquidity, and then when the big move starts, they gobble it up. So Is it sometimes deliberate to run people out of stops? Absolutely. Other times, though, I don't think people go in there. Everybody goes in there with the intention of making money. I don't think traders go in there with the intention of screwing the next guy over, even though that's really what you have to do in order to make a profit. Every time you make a profit, that's somebody else's loss. But I don't think the mindset is really, how can I mislead and screw over everybody else? I think the mindset is more, how can I make the most money I can today? And in the process of doing that is what we call price discovery. Price tested a new low to see if it would find more bears. Okay? It didn't find more bears. Instead, what it found is more bulls who were happy to get the bargain price. Now they can buy down here instead of up here. And that's what leaves these kangaroo tails. Harley, to answer your question, do I check out the trend first? Absolutely. And we're going to get into that when I give you some of the tools to reduce your losses. I actually check the trend on a larger time frame too, not only on one time frame. As for how I pick which pair to trade, there's two ways. The traditional way is simply knowing which country is releasing economic reports on which day. You don't have to trade the news to trade the news. Okay, you have to know what's coming out of which country, was it good or bad, and that gives you an overall feeling of where the currency is going to move. That's still trading the news, but more from a fundamental approach as opposed to a spike chasing approach. So that gives me a clue as to what to trade which day. If I've got news coming out of Canada and the United States all day, really wouldn't do me much good to trade the euro against the yen, now would it? Actually, that's a bad example because the Dow actually affects the euro-yen quite well. But let's say, I don't know, the Swiss franc against the euro. That's a much better example. Why would I be trading the Swiss franc against the euro if I've got news coming out of the United States and Canada all day? I'm much better off trading the loonie, you know? That's a better example. The EJ and the GJ are two exceptions because of hedge fund managers who offset their positions. Anytime the Dow has a bad day or a really, really good day, you can expect to see some movement in the EJ and the GJ. So that's an exception. Boyke, absolutely. A kangaroo tail can also be on top. There's a little one here, a little one here. They're smaller, but every bit as effective. Here's a really big one. If I was long here, for example, and I can actually move the chart over and you see price dropped. If I was long here and I saw this, I would certainly be really, really cautious and think about exiting my long. You know, and sure enough, a drop ensued. But we'll get into the specific indicators that can signal some of these in just a minute. I'm going to cover the psychological aspects first because they're so important. Without the psychology, the technicals will keep failing you every time. You'll keep second guessing them. And here also, see, little kangaroo tail. Now we start moving back up. Dojis are also really, really telling. A doji is any candle that has a body so small that it makes a plus. That really represents a moment of balance between buyers and sellers in the market, or another way to look at it is a moment of indecision. I think dojis are so important, I even color them yellow on my chart, so they really pop out, so I can't miss them. If there's no data released or other news, yeah, I can trade a range. Basically what I do, trading is very simple for me. If I see a range, I identify a range, and I trade in that range. If I see a breakout of that range, now keep in mind, 80% of breakouts are false breakouts. So you have to qualify them. If I see a breakout with a successful retest, okay, meaning if resistance just broke, then price has to come down. Like here we see an example of a range. Okay. Price was moving up, it got knocked down by this resistance. Price moved up, and this time it broke this resistance level. I would not trade this first breakout because most breakouts are false breakouts. What I would do is wait for that breakout to come back out and retest what used to be resistance now as support. Now we're getting into some of the ways to cut your losses, guys. Okay? Filter your trades. Greed and fear lead to overtrading. Both of them do. Greed gets you into trades when you shouldn't be getting into trades. Fear gets you out of trades before they have a chance to work. Okay? both can work against you. So now we're getting into some of the ways to counteract greed and fear, okay? Setting up tests, okay? This held as resistance the first time. We broke resistance the second time, but I'm not going to get excited. I need to see resistance retest as support. Usually resistance will become support and vice versa. So that's what I mean by a retest. It's also called a goodbye kiss. In this case, it didn't work out. You know, I'm showing you guys an example that didn't work out. Great way to build faith in the system. But we would have had other indicators that would have signaled this reversal for us. In general, 80% of breakouts will be false breakouts, and you want to catch it not the first time, but if it successfully retests. We also call this the goodbye kiss. So that's one way. That's one way to filter your trades. The other way to filter your trades, I mean, wouldn't it be great if we had a magic filter that filtered out only the bad trades, but kept the good ones? Wouldn't that be awesome, guys? If there was some magic filter that stops you from taking the bad trades and only got you into the good ones. Okay? Harley wants that. The rest of you don't care, right? Harley wants such a system. All right. I'll PM you my secret, Harley, okay? Since the rest aren't interested. I'm only kidding, guys. Only kidding. Wanted to see if you guys are still with me and still awake. I'll share it with everybody. Okay? Multiple time frame analysis. It actually is that easy, guys. Multiple time frame analysis. Look at a larger time frame. If I look back, this was around 9:30 or so GMT that we got this reversal. If I look at a 30-minute chart around that time, the picture looks very different on a 30-minute chart. Now again, I would have lots of other indicators. Okay, I'm just flying blind here, just looking at price, and I can already tell you guys some meaningful information. Okay? We had price shoot up, and then we had price consolidate into a range. This is the 30-minute chart. Okay? As price actually consolidated into a flag pattern, you see that, or a pennant, and then broke to the downside out of that flag. That's a very bearish pattern. Okay? First, we knew that our up move was over because we had this sharp up move, and now we're consolidating in a range. So already we know the bears are done. The up move is over, and then later on, the pattern actually becomes bearish. So going into the 5-minute chart, I would have known not to take any additional longs here. Okay? Even though we broke resistance and retested it as support, my upper time frame is telling me the bull move is over, so why would I go long? And it's starting to turn bearish. So just by using the upper time frame filter, no other indicators, I would have known not to go long here. Or certainly I would have been much more cautious about it. Okay? And probably my other indicators would have closed the deal and sold me that I shouldn't be going long. So what you do is on your upper time frame, you only need to decide one thing. Am I a bull, a bear, or am I standing aside? That's all you need to decide. Am I a bull, a bear, or standing aside? If you decide to be a bear on your upper time frame, then you are forbidden from taking longs on your smaller time frame. Okay? It's that simple. Bears don't take long trades. Bulls don't short. Okay? So if you decided to be a bull or a bear on the upper time frame, then go to your lower time frame, and keep in mind, stand aside is a valid third choice. One of the reasons people experience losses in trading is because they forget that third choice, stand aside. You don't have to be in a trade at any given time. I have days where I watch a currency pair all day and I don't take a trade. That happens sometimes. Just nothing good presents itself. It's okay. Not losing money is also a valid winning trade. Don't forget that, you guys. So standing aside can be a third trade. Or a third option, sorry. But assuming you make a choice to be a bull or a bear, then when you go to the lower time frame, honor that choice. Okay? Honor that choice. So that means if I get a bullish signal here, like let's say former resistance retests to support. If I get a bullish signal, I'm going to go, no. The 30-minute chart told me the bull move is over. I'm in stand-aside mode waiting to see if a bearish opportunity presents itself later on in the future. But right now I'm strictly stand aside, so I'm not taking a long, even though it looks tempting. That's the magic filter, guys. It doesn't have to be much more complicated than that. That's already going to cut the amount of trading you do in half. And you will find that most of the trades you end up not taking end up being the losers. And the ones you do end up taking have a higher percentage of success. They won't all be winners. I can't give you a magic holy grail that'll be right 100% of the time. Okay? Nobody can. If we had something like that, none of us would be in here teaching classes. You know, we'd be all living on some island, or why stop at island? We'd have our own planet. You know, there just is no such thing. What you do is you control risk reward and you control money management. So the losses that occur, you know, it's like a mosquito bite, no big deal. Meanwhile, the winners really keep adding to your account. That's what you can do. You can't make yourself right 100% of the time. After 14 years of trading, I've gotten up to 77%. And you know what? I make a very decent amount of money just only at 77%. You don't have to be right 100% of the time, but you can take steps to make sure that the other 23% doesn't hurt you. Okay? And that's what we're going to focus on. As far as which time frames to use, a lot of people always ask me this, which time frames to use. I'm going to pose to you that the answer is not so much which time frame is more important than another. What I'm going to propose to you is more important is that you use 2 and that they be a factor of 5 apart. Okay? Meaning, if you normally trade on the daily chart, then look to the weekly chart as your upper time frame. There's 5 days in a week. Okay? It doesn't always work out perfectly. If you're used to trading on a 4-hour chart or on a 1-hour chart, then look to the 4-hour chart as your upper time frame. That's a factor of 4, but close enough. Okay? If you normally trade the 30-minute chart, don't look to the hourly chart as your upper time frame. That's only a factor of 2. They're too close together, and they're going to give you conflicting signals. They're not far enough apart to give you a different enough perspective. Okay? So get used to checking with an upper time frame to see if you're allowed to go long or short, or if you're not allowed to trade at all. And then make sure that the 2 time frames are a factor of 5 apart, at least. M30, you would probably go also up to a 4-hour chart. That's a factor of 8, I know, but it's better than a factor of 2. Sometimes you have to round these things off. If you normally trade the 15-minute chart, then go to the hourly chart. That's a factor of 4. Do not go to the 30-minute chart. Okay? Vice versa, if you normally trade the 5-minute chart, if you're more of a day trader, if you normally trade the 5-minute chart, do not go to the M15. That's a factor of 3. Go instead to the 30-minute chart. That's a factor of 6. That'll serve you much better for a different perspective. So what is critical is that the distance between the time frames, more so than which time frame you're using. That being said, if you're an absolute beginner and you're wondering what time frame to start out on, okay, I would say start out on the daily chart and use the weekly chart as your upper time frame. Now, obviously, that means you're going to have to do some trading on demo, or you're going to have to use really, really small lot sizes. And we'll cover money management in a little bit. But obviously, you're going to have to shrink your positions a little bit if you're going to trade the daily chart. But if you're just starting out, why the heck would you want the pressure and stress of day trading on your shoulders while you're still learning to trade? Start out with the daily chart and use the weekly as your upper time frame. There's an old saying in trading that goes, if you can't make consistent money on the daily chart, then day trading will only separate you from it faster. Okay? So start out on the daily chart and then work your way down. Start out on the daily chart with the weekly chart as your upper confirmation. Keep in mind also, if you're not a full-time trader, probably you're managing this also with a job. Probably you're managing this with family responsibilities. You know, the average person these days has a lot on their plate. Why would you want to trade something that keeps you glued to the screen 24/7? Start out by trading a daily chart and look to the weekly for confirmation. Do it on demo for a few months to at least test your system and test your theory. See if you're right more often or wrong more often, right? The good thing about a daily chart is you can wake up half an hour earlier before you go to work, open up the charts, see if there's a position you want to take. If you ended up taking a position, then you can check that position after work to see if it's going in your favor or against you, see if you were right or wrong. You can check that position again before bed and again the following morning. Things take longer to develop. It's much more compatible with having a day job. Everybody wants to start out day trading. Then go to the casino. At least there you get free drinks while they take your money. Seriously, guys. If you cannot make consistent profits on a daily chart, day trading will only help you lose faster. Okay? I've seen this tested lots of times, guys. And it's true. I'm trying to think if I've seen any exceptions to this rule, and I really can't. I can't think of a single exception. I've met people who are day trading when I first meet them, but usually they're people that have a couple years experience under their belt. I don't think I've met anyone who said, haha, I didn't follow your advice and I'm making tons of money on the 1 minute chart and it's my first week trading. Maybe one or two guys, but usually the next week they came back and I said, so how's your trading going? Oh man, I just blew out my account. Sorry, dude. That's the sort of thing I try to prevent. That's exactly why I'm out there teaching every day. I'm trying to prevent exactly that sort of situation. So some things you can do right off the bat. Start with a larger time frame. Now, if you have consistent profits, because it's a daily and weekly chart, here you might need 2 to 3 months, okay? But the next steps you can do faster. If you have consistent profits there, and you want to experiment with more intraday trading or more swing trading, then try moving down to the 4-hour chart and using the daily as your upper time frame. Okay? Start out with the now move down to the daily as your upper time frame and the 4-hour as your lower time frame, and see if your consistency can be maintained or if you experience a sharp drop in your statistics. If you can maintain that consistency, now here, this one you can do for maybe 3 or 4 weeks. Doesn't have to be 2 or 3 months. See if you can maintain the same consistency. Then go down to the hourly chart as your main time frame with the 4-hour chart as your confirmation. See if you can maintain the same consistency. And keep doing that until you notice a sharp drop in your consistency. When that happens, you've found the lowest time frame that's comfortable for you. And every person is different. Every person's psychology is different. And also every trading system is different. It might not have anything to do with you. It might have something to do with the trading strategy you're using. Okay? So keep working your way down till you find your breaking point. Find the point at which your consistency suffers, and you know that time frame is too low for comfort. Then there's no need to test anything lower. Okay? You found your ideal trading space. You will get much better starting at the wider time frames, working your way down, than starting at the 1 minute chart, getting all frustrated, or worse, blowing up your account and then quitting. That's not going to get you very far. You'll never get a chance to try the 4-hour chart then. Work your way down rather than up. And the other thing is, on the upper time frames, things happen much, much slower. So you have much more time to react. You have much more time to check other sources, other opinions, and really think things through. Or maybe try a different indicator to see if it confirms your findings or contradicts them. You have much more time to think things through and react. So especially when you're learning and starting out, you want to be doing everything you can to remove the stress and pressure from your shoulders instead of adding additional stress and pressure. Don't try to live from trading for your first month out. You're going to go nuts. People encounter stress at 2 points in their lives. In trading, I mean. One is when you go from a demo account to a live account. Anytime you go from demo to live, psychology becomes much more of a factor, and everybody I know experiences losses when they first move from demo to live. So even if you have a pretty good track record on demo, as soon as you go live, cut your position sizes in half, at least, if not more. Because there will be a period of losses while you now get used to, when you're on demo, you're learning a technical strategy. Okay, you're learning how to read charts, how to react, and you're learning how to use indicators. You're learning about strategy. Once you go live, you have to learn about psychology and money management and yourself. You can learn money management a little bit on demo, but it really doesn't hit home until you go live. So everybody experiences a sharp drop when they go from demo to live. It's normal. plan for it, cut your positions down so you don't wipe yourself out during that transition period. The second time people experience really heavy losses is when they either quit their job to trade full-time, now you're living from that money, or if you're already a full-timer, when you take on somebody else's money for management and you know other people are looking over your shoulders. You know, either way, if you're trading just for yourself, then it might be your wife or your husband looking over your shoulders. You've just quit your job and you have to prove to them you can make as much money doing this, and the family doesn't have to go to eating oatmeal every morning, you know, and every evening. You know, so you're under sharp scrutiny, and also yourself. You have a lot of expectations of yourself. So that's the second time people typically experience sharp losses. So why would you as a beginner with no trading experience want all of that all on your shoulders all at once, plus be dealing with a price chart that every 30 seconds looks completely different? You know, daily chart, you at least have at least 4 or 5 hours before it starts looking radically different, a lot of times half a day to a day, you know? So do everything you can to minimize the stress and pressure, and this is part of psychology, rather than increase it. You know, don't try to trade with a screaming baby in the background and a barking dog. You know, ask your spouse, designate a couple trading hours per day while you're getting started. You may be trading, or you may be just doing reading, or you may be just doing research. You might not even be trading. But designate a couple hours, make an agreement with the spouse to watch the baby and the dog and everything else. Go into the office and close the door and really concentrate on what you're doing. That's part of psychology, and it's part of things that are overlooked. All of these things will help cut your losses, and that's the focus today. Multiple time frames to filter your trades. That's something else. Give me a quick minute to catch up on some of your comments and questions, and then I'll move forward with some other tips to cut your losses even further. Is there a specific length of the tail? No, it's different every time. I haven't found any trading strategy based on the length of the tail. However, based on the whole retracement, Fibonacci can sometimes tell you how long the extension would be. You know what I mean? Not this tail alone, but measuring this whole move from down here to up here might give me an indication of what might be coming next. And we'll get a little bit into fibs during session 2 today, Mabel. But just the tail alone, not really. It doesn't gauge you a distance. Certainly if it's longer, the rejection is sharper. You know what I mean? So the longer it is, sometimes the longer the ensuing move can be, or at least the sharper the first takeoff of it will be. But not always. Not always, because here we had a long one and a short move. Here we had a short one and a long move. You know? So not always. It certainly tells you there was a lot more disagreement between bulls and bears when it's longer. How do you identify a kangaroo tail? Just by looks, Leo. It's right here. Whenever you have a V in price and a little tail hanging off the end. Kangaroo tail is basically the same as a long candle wick. Okay? I'm pointing to one example right here. That's all it is. It's when a candle has a long wick and then a reversal comes right after. Usually a reversal comes right after. PA, I'm not quite sure what you're asking. What amount would one need to spike a pair? I'm not sure quite what you're asking me. Are you asking me what one would need as a minimum account to trade? We'll get into money management a bit later on. I'm certainly going to cover some of that. But as far as spikes, I don't trade spikes, so I'm not the best one to ask. I trade before spikes and after them. Kangaroo tail absolutely can be on top. Here's an example. There's a little one up here. There's another one here. Can happen in both directions. And cannabis, absolutely. The bad thing about a range is the spread. maybe trade a different pair that has a lower spread, or don't trade that range. Remember, there's that third option, trade aside. I always look, when I identify a range, I don't necessarily go to trade it. Okay? If I identify a trading range, first thing I need to do is take a look and see if that range even makes sense for me to trade. Is it wide enough? And then once I plot all my moving averages and pivot points and fibs and everything else I like on my chart, I look at to see how many barriers are in that range. Is it pretty empty, clear sailing, or is there a lot of stuff in my way? So a lot of times I'll identify a range and I simply won't trade it. Okay? Valid option as well. Just to stand aside. A range has to be worth your while. Well, that's an interesting question, Tosh. Normally, charts don't show gaps because currencies are a 24-hour market. Typically, where gaps happen, you see them a lot in stocks. You see them a lot in stocks. And what happens is the stock markets close overnight. They don't trade 24 hours. Meanwhile, while the stock market is closed, there was some news about a company came out, or there was some movement in the futures market, you know? And then the stock has to open the next morning, but price has already moved while it was closed. So they're certainly much more common, but we've actually seen quite a few gaps. There was one today, and there was one yesterday, even in the Forex market, right here. All it means in the Forex market is that when this candle closed, the next candle opened much higher. They're much more rare in Forex, but they do still happen. There's even a little tiny one right here. Usually in times of high volatility, you'll see this. And the euro-US dollar is no exception. We're right now at a very key level, 1.60. The European Central Bank has vowed to protect that level, quote unquote, whatever that means. Draw your own conclusion. And certainly almost every company in Europe that exports is really worried about the euro. They were already worried about the euro crossing 150, but they're downright terrified of it crossing 160. So there's a big, huge battle going on between bulls and bears. Some people think the trend just ended. I actually, for FX Street, wrote an article yesterday about the end of an 8-year-long Fibonacci pattern that's been going since December 2000. Okay? Just came to an end on the euro-US dollar. So some people are thinking the rally here is just beginning, that Europe is worried about inflation, America is worried about recession, so the euro-USD is going to go even higher. Other people are saying, you know, a big move just completed. We're at a critical level. It's got to go down now. The only thing I can say with any certainty is we're going to have a lot of rangy back and forth trading between 1.59 and 1.60. You know, could last for weeks. We'll see. We'll see what happens. It's already lasted for about 4 weeks. You know, the only thing I can tell you is there's a big fight between those that think it should go up and those that think it should go down. Who will win still remains to be seen. It's very much in the air. So that's one thing that can cause gaps, when there's a lot of disagreement between bulls and bears. Or when there's a lot of agreement, right? So they do certainly happen, just much, much less frequently. As far as the time frame, Leo, it can be any time frame. Whatever is your lower time frame or your main time frame. The upper one we just use for a sense of direction, bullish, bearish, or standing aside. The lower one is where I would look for a break and retest. Doesn't have to be a 5-minute. I just happen to have a 5-minute open here because that's what I was trading just before class began. But it doesn't have to be a 5-minute. It's whatever your main time frame is most of the time. And you're right, Rami. The retest right after worked out in the opposite direction. Oh, I moved my line. I moved my line, but the retest in the opposite direction worked. Support broke, retested as resistance. Here it is. Let me move my line back up and I'll show you. We had a retest of this line as support. We broke through it. We retested as resistance, left a kangaroo tail and a doji. Look at that. Everything at once. And sure enough, that signaled the start of a new downtrend. So absolutely, it works in the opposite direction. Sometimes it's like that. Here again, Overtrading, greed, and fear. If people were just patient, a little more patient, if they just gave it one more candle or two more candles, everybody always thinks price is suddenly going to spike. Price spikes during news. Most of the time it very rarely spikes. Usually what price does, look at here, when it's coming up, the candles slowly start to get smaller. Then you start out with small candles in the other direction that gradually accelerate. Then usually the move comes. Very rarely does it suddenly sneak up on you. That's only during news. And you can just check Forex Factory or a number of any other sites, and you know when the news is coming up, what time it's coming, so it doesn't surprise you. Barring news, usually price doesn't spike in one direction or the other. It'll slowly turn around first. So you have time. Get that thought out of your head that the train's going to take off from standstill to light speed with no acceleration in between. Okay? Most of the time people overtrade, and that's what causes 99% of errors there. Everything you guys listed when we started this class was some form of overtrading. Okay? It really was. And that's exactly what we're working on, is ways to minimize that. If I can get you guys to trade less, I can guarantee your results are better. I will do a second part to this webinar today that focuses on maximizing your profits. But really, even if you only attend part one, I guarantee you'll see results and improvement. Because if I can just get you guys to stop trading, I can get you to stop losing. The wins will come later. Okay? That's the number one thing. People always ask me, you know, what can I do as a beginning trader to cut my losses? Unplug your mouse. Seriously. That's it. Just unplug your mouse. If I can get people to stop trading or to trade less often, you would lose much less often. Kramer even, his new show, besides Mad Money, his new show on CNBC, it's called Stop Trading. The man's onto something. As far as several charts up on my screen, I do have several charts up on my screen, usually time frames that I can watch, and you're onto something, Harley. This comes into another thing, spreading yourself too thin. One of the main reasons people lose. Don't try to follow 10 different currency pairs at the same time. Follow one currency pair, but follow it on 2 or 3 different time frames. I personally would never have the 15 and the 5 minute up at the same time because they're too close together. I like a factor of 5. So if I saw something interesting on the 30-minute chart, I would go down to the 5-minute chart for a tactical entry. If I saw something on the 15-minute chart, I would go up to the 1-hour chart for confirmation. I wouldn't go from the 5 to the 15. And that also brings up the question you guys asked, how do I know which pair to trade? Well, I shared with you one answer already. Simply know where the news is and news price. We're back to fundamentals. So knowing where news is going to come out gives you an indication of which pair to trade. I do have to admit, though, I have a little bit of a secret weapon also. I'm going to give you guys a link. You can mark it down and find out about it a little bit after class. That's a link to my website and a special software out there called Acuity Software. It actually has a temperature map where it compares the volume and the volatility and the bulls versus the bears of every pair out there, and it gives you a temperature map. So very simply, I look at my temperature map and I just trade the strongest currency against the weakest one, or the weakest against the stronger. So there are tools that can give you an edge, but I hesitated to bring that up because don't rely on tools. Fix the trader first. That's what we're here to do today. Fix the trader first, learn how to drive, then take the Lamborghini for a spin. Okay? But there are tools out there that can make it easier to decide which pair to trade when. What I would recommend is just pick one and trade it for a month. Okay? Don't worry about switching from pair to pair. Pick one and trade it for a month. I guarantee you'll see results. Because every pair also has its own personality. Okay? If you walk into a bank, you won't find a guy trading 20 currency pairs. You'll find a guy that's a specialist just in euro futures. You'll find another guy that's a specialist in dollar futures. You'll find another guy that's a specialist in the yen. Okay? You don't have people trading different pairs. Everybody's assigned to watch one market, and they watch every twist and turn of that. So logically speaking, since we know bank and institutional traders move the markets, when you're trading a certain pair, you're trading against those traders, okay? And when you switch from EU to GU, for example, logically then, you're switching opponents. Because in a bank, typically, you won't have the same person trading both pairs. So logically, when you switch from one pair to another one, you're switching opponents. Now, imagine you're in a brawl on the street. Do you want to take on 5 opponents at the same time, each with a different fighting strategy, or would you rather take on one opponent at a time? Right? I mean, obviously the best answer is no opponents and live a peaceful, cheery day, right? But if you were attacked in an alleyway, wouldn't facing one opponent be better than 5? So start with one currency pair. Start with one group of opponents and really learn their personalities. Do they pay attention to pivots more or to fibs more? Do they pay attention to moving averages? When they hit a moving average, do they typically break it right away, or do they stick to it for a while and then break it? Do they overshoot it by a little bit, or do they stop right on a dime? These are all what I call personality traits of a currency pair. Does it pay attention to the round numbers like 50 or 100? Okay? Or does it overshoot them? You know, some pairs don't stop at 100. They stop at 10 and then come back to 0, 00. Some pairs, like the pound-yen, they typically overshoot by 20 or by 30 to 40 pips, and then they come back to the round number. So every pair has its own unique personality, and that's based on the people trading it. So the more you focus, the more you learn the personality of your opponent, sometimes even to the point you begin to anticipate their moves. And that's what we're really after. Okay? I'm jumping ahead, Ricardo. I didn't miss the rest of your questions. Technically, it would be a little of both. It would be both. I don't trade the hammer as much, so I'm not as much familiar with it. But in this case, I think it would meet the definitions of both. Certainly, it's a kangaroo tail. Don't get so hung up on the definitions, guys. Also, trading is very much more of an art than it is a science. You need the basic rules so you have a starting point, but it's much more so an art than it is a science. Let me catch up on the rest of your questions. Larger time frame indeed involves a larger stop loss, Mabel. That's why I say you might have to get used to smaller positions or demo to start. But if that's the price you pay to really learn the solid foundations of trading, it's a worthwhile price to pay. It's certainly cheaper than losses. Okay, let's see. Okay, a few of you guys brought up that point. Boyke, Leo, same thing I just told Mabel. If you have no experience trading, I recommend you begin on daily charts and look to the weekly for your upper confirmation, and I recommend that you do that on demo for several months, okay? Till you can really prove that what you're doing out there works, and it works repeatably and reliably, okay? So absolutely. It means you might, even if you've already gone from demo to live and you're still relatively new and you're just struggling with a $1,000 or $2,000 account, take a month or two off from trading that live account and go back to a demo, but try the upper time frame. Absolutely. Things happen much slower. You have much more time to react. So absolutely, I do recommend that, especially for the beginners. And if the price you pay is switching to demo, it's a price well paid. It's better than losses on a real account. How do I determine bull or bear in the upper time frame? Well, that depends on my system point, Tom. Same system I use on the lower time frame, I use on the upper time frame. I just don't get into the nitty-gritty of it. You know, for me, from all the indicators I use, some of them I'll cover in session 2. From all the indicators I use, my rule is I need 3 to 5 of them to agree to get me into a trade. Here we go again, filtering out the losers. I don't jump in because one thing looks good. I wait until 3 to 5 indicators on my lower time frame look good, then I enter a trade. And I only need one to get out. Okay? 3 to 5 to get in, 1 to get out. That's my lower time frame. Now on the upper time frame, I use the same exact chart template. I use the same exact indicators, but maybe I don't need to nitpick and look at for 5 to agree. If I see that 2 or 3 things are bearish, then I know I'm a bear. Then I go to the lower time frame, and that's where I do my nitpicking to see if I can find a good short entry. If I find a long entry, I ignore it. But same way I do on my lower time frame. That's the short answer. The specifics I'll give you during session 2. Okay, how many indicators would I use? Harley, the short answer to that is many as I need and not too many. Great that you brought up indicators. The other reason that people oftentimes take bad trades or losing trades, I mean, can I get a show of hands? Who wants to lose on purpose? Who really wants to go out there and lose money today? Okay, not very many of you. I figured. So nobody wants to lose on purpose. Typically when we lose, it's on accident. Could be a psychological mistake, which I've given you guys some tools to cover. By the way, the best tool for controlling greed and fear, stops and target. I totally blew over that, but that's the first and the most important thing. I guess for me that's obvious because I've been trading a while, but if you're new, that might not be as obvious. I never place a trade unless I have some idea where the stop and target is, and most of the time I put it in as a pending order as I'm placing the trade. But at the very minimum, I always know where it is. Stop and target, absolutely critical. The stop will control your fear and your greed, and the target will control your greed. If you don't know where a good place to place a stop and a target is, then you should pass on that trade because you haven't studied it enough. Always know your stop and target when you're getting in. That's the best way to control it. So most of the time when we take losing trades, it's when something goes wrong. Either psychology got the best of us, or maybe we read an indicator incorrectly. I found that people put a bunch of indicators up on their charts, but when I ask them to tell me, is that a momentum indicator or a trend following indicator, or is it an oscillating indicator, typically they give me a blank look in return, like, huh? You gotta absolutely know what your indicator is and what it does, guys. Okay? There is 2 main groups that most indicators fall into. One is trend following or momentum indicators, and the other group is the oscillators. You always know an oscillator because they oscillate back and forth between 2 sets of numbers. RSI is a good example of an oscillator, the relative strength index. Stochastics are a good example of an oscillating indicator. The CCI, channel commodity index, is an oscillator. That one doesn't oscillate from 0 to 100. It oscillates from negative 300 to positive 300 and zeros in the middle, but it still oscillates. Some examples of trend following indicators might be the MACD, right? Moving average convergence divergence. The OSMA, which is similar to the MACD. The ADX, average directional index from Wilder. These are examples of trend following indicators. So it's very, very important to know the indicator that you're using. It's important to know which group it falls into. It doesn't help you to have 2 trend following indicators. They're not going to tell you anything new from each other. I traded for a while with a MACD and an OSMA on my chart. You know what? They look so close together. If you have those 2 indicators and nothing else, you're flying blind. So more important than which indicator you use is knowing which group your indicator falls into, and to make sure you have 1 indicator from each group. Okay? Have 1 trend follower and 1 oscillator, not 2 oscillators. They will serve you much better. Most people don't even know which group their indicator falls into, let alone to make sure they have a balanced collection of indicators. And that's one of the common mistakes I find, is people throw indicators on their charts because they look neat or because somebody told them they're really effective. But they don't really know which piece of the puzzle that indicator is supposed to be telling them. Okay? So know which group yours falls into, and know and know which group to use when. Because here's the trick, guys. It's great when our indicators agree with each other, but a lot of the times they don't. Okay? And if your trend follower is telling you up and your oscillator is telling you down, you need some way to know which to listen to and which to ignore. Here's the trick. Okay? When you're in a range, your oscillator will serve you the best. Because what do? They oscillate between 0 and 100. Right? Makes sense. They oscillate between 0 and 100, and they can effectively help you pick the tops and bottoms of the range. They can also give you a clue, letting you know if price is going to stay in that range and bounce back in, or if it's likely to break out of the range and your range trading is done. So when you're in a range, use the oscillator or give it more weight. When you're in a strong trend, you're going to find that your oscillator right away starts braiding and it goes into overbought or oversold territory. You know, if you want a good example, bring up a monthly chart and apply the stochastics to the Euro USD and take a look. You'll find that we've been overbought for the past 4 months. Well, good luck trading the Euro USD using stochastics. You know, well, we're overbought. Good, thank you for telling me that. For 4 months, it didn't give you a different signal. You know, so good luck trading using the stochastics when you're in a strong trend. Meanwhile, a trend following or momentum indicator does exactly that. It measures the strength and weakness of a trend. It tells you whether that trend is getting stronger or weaker. So rule of thumb, know which group your indicator falls into. If they both agree, and have one from each. If they both agree, fantastic. If they disagree, then look to see if you're trading within a range or within a trend. Okay? If you're in a trend, put more weight on the trend following indicator, meaning watch the MACD a little bit closer than the stochastics or closer than the RSI. If you're in a range, then don't let the MACD trick you into entering or exiting early, and follow more closely the RSI or the stochastics, or the CCI. So know which indicator to use when. Critical. And which ones you use, Harley, is much more important than how many. Okay? More important is to have your ducks covered. Have one that measures the strength of your trend for you. Have one that catches reversals so you can use it in a range. As far as I know, Mabel, they are recording the session today. Woo-hoo! I'm glad too, because I'm hoping people come back to this and review this. I hate it when people lose money, so I want to cover the best ways I know of to cut losses. And it's great that it's being recorded. How do I recognize whether price is consolidating or taking a bearish turn? Well, Mabel, I'll get into some of the specifics during session 2 when I actually get into some of my indicators. Simple stochastics might show me that, for example. Trend following indicator also, if it starts going into the red, will certainly show me that. But basically, if I suspect a range, if I see price zigzagging back and forth, I right away draw that range. How do I know the bears are overpowering? Well, we break out of that range. That's the most obvious way. But I do have some indicators that fine-tune that, and we'll take a look at them later on. One thing I do want to give you guys, actually, thank you for the reminder, especially for the 1s and 2s in here. Let me give you a quick link, another link to my website where I cover some of the basics, such as the indicators, when to use which one, which group they fall into, and things like that. Some basics to at least get you started in the right direction. That's actually in our forum, and I encourage you guys, drop by. Our forum is completely free. Oops. That link is good too, but here's the link that gets you specifically to the introductory lessons. But drop by our forum, it's absolutely free. Ask your question in there, or look and see if your question's been answered already, because we've got a lot of talented traders besides myself that frequent that. And also, drop by our chat room sometime and say hello. Okay? Both resources are completely free, and there's lots of other free stuff on my website. So some videos to watch, market updates. I've got a chart that you can use that detaches from the website. You can plot most major indexes, like the Dow, the FTSE, the Hang Seng. You can even plot indicators on them, oil as well. So lots of little tools and utilities. Spend some time exploring the site, and hopefully you'll find some further things to help your trading. What info you need? Nothing, just your name and email address. I do verify email addresses to rule out the spam bots, so we don't have spammers harassing our traders. But one thing you have to make sure of is that you have pop-ups enabled, all your pop-up blockers disabled, including Google Toolbar. People forget that that one blocks pop-ups as well. Or just add FX Knight to your trusted sites list, and then you should get it. And if you're having a problem with a validation email, could be that it landed in the spam folder. Check your spam folder. And if you're still having issues, go ahead and send an email there, accounts@fxknight.com. Be sure to let them know your username. It's amazing how many people write in and say, I couldn't log in. Great. Thanks for telling us. But go ahead and write in with, specifically where you're trying to log in, chat room or forum, because they have different databases. So you have to register for an account with both. Specifically where you're trying to log in and what your username is, and maybe they can help you out further. But usually I found out 99% of the time it's a pop-up blocker or a spam filter. Unfortunately, we have to use pop-ups because sometimes we have to load things from an external site, right? We're a financial website. We don't have a team of 100 analysts working 24/7. I have to pull in feeds from other places. So we do use pop-ups and links to other sites, but they're legitimate. I promise you, there's no malware, spyware, adware, or anything like that on my website. Nothing's being tracked or recorded, but we do have legitimate reasons for using pop-ups and links to external sites. It's the nature of running a financial website. All right. By the way, guys, the reason I'm taking your questions is because your questions are actually covering some of the stuff I intended to cover anyway. So I will leave time for questions also at the end, but your questions are great. I'm actually in the process of covering your questions, covering the topics I was hoping to cover with you. So, as the title implies, today was meant to be a conversation with a pro trader. So anything I can do to lend some of my experience to help you guys in the right direction, I'm glad to. Alrighty, let's see what else. How much minimum capital to start? Great question. It depends what you plan on trading. Here we're getting into money management a little bit. Let me give you a couple rules with money management. Assuming your stop gets hit, worst case scenario. Okay? Worst case scenario, assuming your stop gets hit, you want to lose no more than 2% of your account equity. No more than. Okay? Doesn't mean you have to risk 2% on every single trade. Most of my trades I take 0.5% or 1%. I only trade up to 2% on the trades I really feel 200% confident about. Make sense? If I'm only 100% confident the trade will go my way, then I might only bet 1%. Okay, so up to 2%. Now, if you don't know where your stop is before entering a trade, how are you going to know how big to make your position, how many lots to put on the trade, right? Goes back to what I said, know where your stop and target is before you get into that trade. If you don't know, then do a little more work, a little more research on your trade. Don't worry about the trade running away from you. If the trade looks awful 5 minutes later, then you shouldn't have been in that trade anyway, right? So what are you worried about? Take the time to really work out a trade. Know your stop and target before you get in. And if you find yourself rushed on your calculations, move up to a higher time frame where you have more time to do exactly that sort of thinking. So, assuming your stop gets hit, no more than 2% of your account equity. That's probably a lot less than most of you are used to trading with. Assuming your stop is 20 pips away, and you have a $2,000 account, you should not be trading with more than one mini lot. Sorry. That's probably a lot less than you thought you would be trading with. You want to trade with 2 mini lots, you better make sure your strategy allows you to safely put your stop 10 pips away. Now, I'm not saying cut your stop distance arbitrarily in half. That's dangerous. Okay? You have to use stops that are proportionate to your time frame, and you have to use stops that are proportionate to your trading strategy. Okay? So you can't arbitrarily cut your stops in half. But you can cut your position in half to accommodate the wider stop that your time frame or strategy requires. The two are interlinked. No more than 2% of your account equity. Were you hoping to trade with more than 1 or 2 mini lots? Well, think about putting 5,000 in your account instead of 1 to 2,000. Okay, that's just the reality of it. It's kind of a shame that most brokers, if you open your account with a few $100s, they let you trade a mini account. As soon as you can deposit 2,000, they let you go up to a full-size account. I think that's wrong. I think to effectively trade a full-size account, you need at least 10,000, at least. Because you want to also allow for things like scaling into positions and scaling out of positions, meaning you add to your position when you're winning. When it starts going against you, you start closing part of it if you're not sure. More advanced strategies like that require you to trade with more than one lot at a time. So I think it's a mistake to open a full-size account with only 2,000 bucks. Maybe 5,000 as a bare minimum if you already know what you're doing and you have the background and consistency in place. But I would say 10,000 is a bare minimum for full-size lots. If you have 5,000 to trade, what you can do is trade mini lots much more skillfully. Okay? That's my personal take on it. Don't I get more stopped out if I put on a stop? No, I preserve my capital to come back and trade a different day. If you're getting stopped out more often, then you're putting your stops in the wrong place. They're not fitting the strategy or the time frame you're trying to use. Maybe try to trade the same strategy, but use a wider stop. Okay? A stop has to have some reason behind it, which brings me to another reason people lose. They put their stops arbitrarily, like, I always put my stop 10 pips away. I always put my stop 20 pips away. No, no, no. What I do is I look and check and see where my support resistance is. Okay? Let's say, let's just say for the sake of example, I've seen that this is a support level, and now we broke the support level, so I'm thinking to go short. Okay? I probably would go short after we do a quick retest. I would short more likely here, myself, than on the first break. That's just me. A retest does not have to touch the actual level. It just has to go towards it. So just me, I would be looking to enter here. Well, where would I put my stop? I would put my stop on the other side of that support resistance level with a little bit of a buffer to allow for volatility and also for my spread. But basically on the other side of a support resistance level. I always place my stops strategically, not based on a numerological arbitrary level. Okay, there has to be a reason for your stop. That's the most important thing. So what I do is I actually calculate the stop first. How far, using a good strategy, does my stop have to be? Now, based on that, I can determine the lot size using the 2% rule or the 1% rule, depending how confident I am on my trade. So no more than 2%. The other part of that equation is no more than 6% of your account equity at risk at any one time as a sum of all your open positions. Okay? Though if you're just starting out, why would you want to manage 3 positions at the same time anyway? That's the same as trading 3 currency pairs. Get good, really good at trading one currency pair and one position at a time, then look to add multiple positions and or multiple currency pairs. Okay, get good at one thing before you add the next thing. How many of you learned to ride a unicycle, juggle, and ride that unicycle down a tightrope on your first lesson? You know, nobody, right? So learn one thing really well first, then add to your repertoire. Doing dojis is very easy. Just right-click on an empty area of your chart, go to Properties, and under Colors, it's the line graph option. If you use MetaTrader 4, whatever you color the line graph, that's what the dojis look like when you do a candlestick chart. Okay, because there's no body, they're considered a line graph, I guess, by MetaTrader. So just change that color and you'll see your dojis popping out. So the rule implies no more than 6% of your account equity at any one time. Logically, you would think that that means you can trade 3 positions at once. Actually, even that rule is flexible. Everything is flexible within that. Just like you can modify your lots and your stops, you can also modify how many positions you have open if the situation warrants it. For example, nobody said every trade has to risk 2% of your account equity. If you're only risking 1% per trade, you can have 6 positions open at the same time, right? The other way you can open additional positions is if you move your stop. You are allowed to move your stops, guys, but only one way. A stop can only move in the direction of your trade, never against it. Okay? It can only move in the direction of your trade to protect your profits. You're never allowed to give it, oh, just a little more room. Maybe it'll turn around. The reason for that is you were thinking much more rationally and logically before you were sweating the trade. So stick to what you decided when you didn't have that stress and pressure on you. Never move trades, never move stops wider to give it a little more room. As the trade starts to move down, you saw here we maybe encountered another support level, then we broke through it, then maybe move your stop down here. Here we encountered another support level. Once we break below it, maybe move your stop down further. Only move stops in the direction of your trade to protect your profits in case something unexpected happens. If in moving that stop, it moves above break even, meaning now if you get taken out with your stop, you still made a profit, right? Great position to be in. If you win, you win. If you lose, you still win. Then you can open up a 4th position. That's the other exception to that rule. But that's Money Management 101. 2%, 6%. We'll get into more details during session 2, how to fine-tune that. But just within 2%, 6%, you'll save a lot of trouble for yourself. Let me see. We've got a few minutes remaining. I'm going to try to get to as many of your questions as I can. Please be patient with me. I am going to scroll up. So if you think I missed you, maybe I'll get to you. Don't worry. Leo asks, how can I identify a kangaroo tail if I only see it 1 or 2 candles after the kangaroo tail? What's wrong with waiting to get a clearer picture? I'm trying to minimize overtrading. That's the whole goal of today's seminar, so nothing wrong with waiting. Oh, as a big player to produce a stop hunting spike. Well, that it's hard to calculate just off the top of my head. Forex is roughly a $3 trillion market right now. To move price, I know when the IMF was talking about selling 400 tons of gold, that certainly moved the gold prices. I know when China dumped 1.2 trillion into the currency markets, that screwed it up for the better part of a month. That was actually May of last year. That was my losing month. Last year, I know once when Bear Stearns was being bought out, or forcefully bought out by JP Morgan, isn't it awesome when the government helps you buy out your competition for pennies on the dollar? But when that buyout was happening, it turns out that Bear Stearns was actually short the dollar. A lot of people are speculating that the Fed was actually punishing Bear Stearns for shorting the dollar and going against their policy. But they had to unwind about $56 billion of dollar shorts while they were being closed, and that's what actually caused, I think, the dip that we saw in the euro-US dollar. It was continuing up strongly. It's continuing up strongly, or it was before about 3 hours ago, but it was continuing up strongly again, but we had that dip in between. I think that was really Bear Stearns being forced to liquidate their dollar shorts. That was about $54 billion worth. So I can cite some specific examples that I know move the market, but how much it requires to make a 3-centimeter spike on a 5-minute chart, I really have no way of calculating that. That's left to much better minds than me. Effective use of a stop, Rami, has to do with support resistance levels. My rule of thumb is 2 support resistance levels between price and my stop. That can be a prior support resistance, that can be a moving average, that can be a Fibonacci level, that can be a pivot level. Lots of different things can create a support resistance level. It can be prior price action. Oh boy, you know, I saw price really did a big reversal here. I might mark that point and have that be a support resistance level if we come back up to trade in that range. You know, actually twice. If you look here, that level was important. So support resistance can be any number of things. My rule of thumb is usually I like to have 2 between price and me. It can be a moving average and a fib level, for example, you know. Or it can be, sometimes I let it be 1 if it's something really, really important, like the 200 moving average. Then maybe 1 support resistance level between price and me is enough. It all depends on the particular situation. We'll take a look at some specific examples after the break. Oh, Hamer, an indicator to show you how much time is left in the time period. Yes, absolutely important. It's good to know when a candle is going to print. Give me 1 second to verify. To make sure the link I'm giving you is correct. Give me 1 second. It's kind of hard to flip over and follow links because Hotcom always insists on putting itself in front. But there we go. There you go. You can download that indicator and a couple other useful ones totally for free from my website if you use MetaTrader 4. I didn't pick the name kangaroo tail. It's just what's been out there for common use amongst traders. Can we trade just using Fibonacci? I wouldn't recommend it, Mabel. If you want some examples how to use fibs, I do have some videos you can watch at that link to show you how to use fibs, but I absolutely would not recommend using them alone. I always use other indicators to confirm any move that I get into. My rule of thumb is 3 to 5 reasons to get into a trade, 1 reason to get out. Libra, as far as other pairs analysis, I'll do some sample analyses during session 2. I haven't shown you enough indicators yet. Price is my main indicator, but I wouldn't analyze solely on price. So in order to do that effectively, I would have to teach you guys a few more things. And that's what we're going to do in session 2. The movement in pound yen is being caused by the Dow movements, Edulac. How do I know if the pair is tracking pivots, fibs, or major support resistance level? Well, one thing, I've watched that pair for a while, so I know its personality. And then the second thing, I simply look, is price, if this was a fib level and I see price absolutely sticking to this level, if I see price sticking to this level, then I know that people are watching that level. If price is hanging off of that level, then I know people aren't paying as much attention to it. Okay? Simple as that. And if I see if we're consistently sticking to pivots and overshooting the fibs, then I'm going to pay attention more to pivots that trading session. I let price tell me the story. And that's something important, guys. Don't go in with misconceptions, or preconceptions, sorry. Misconceptions will also hurt your trading. Don't go in with preconceptions and trying to prove yourself right. Go in with a blank slate as much as you can, a totally neutral mindset, and let price tell you what it's going to tell you. Okay? You know, when I say go to a larger time frame and decide to be a bull or a bear, that doesn't mean now on your lower time frame you're looking for shorts. Don't look for anything. Okay? The great trades jump off the chart at you. Okay? They jump right off the chart. You don't have to squint. If you find yourself squinting at a chart going, should I, maybe, possibly, pass on that trade. There's more than enough good trades out there that you don't have to take the so-so one. Remember, the theme for today is cutting down on overtrading. Your losing trades are coming from overtrading. When we filter out your trading, when we filter down your trading, we will automatically filter out the bad ones and focus just on the good ones. The two go hand in hand. Whatever the cause of the overtrading, your losing trades are coming from your overtrading. If you trade less, you will win more often. I guarantee you. It's worked with everybody. People have different reasons for overtrading and different mistakes they make. And keep in mind, getting out of a position too early is also a form of overtrading. But when people overtrade, or when people lose a lot, those losses come from overtrading, whatever the reason for overtrading. So if I can get you guys, that's the overall theme for today. If I can get you to trade less, you will win more often. Okay? I promise you. What do I recommend to start off with a mini account? Ricardo, I'd say if your strategy allows your stop to be 10 to 15 pips away, you can get by with $1,000 and trade one mini lot every time. Okay? If your strategy requires a wider stop, you won't even be allowed to trade one mini lot. Then you have to trade micro lots if you're only opening with 1,000. To effectively do some scaling into positions or scaling out of positions, meaning you need a minimum of 2 mini lots, I would say 2,000 is much better to start with. But keep in mind these are minimums. I normally say about 5,000 to trade a mini lot, to trade mini lots really effectively and use more advanced strategies. 5,000 is a good number to start at. If you don't have that much to trade with, don't despair. You know, look for a broker that offers micro lots. Nobody says you have to trade huge amounts. Once again, the huge gains, if you don't know what you're doing, will lead you to make huge losses along the way. And one of those huge losses will hurt your account so much, you'll be done trading. You won't ever recover. So don't go for huge gains. Huge gains bring with them huge losses. Go for small gains, but make them steady. Okay? You'll get much further doing that. Thank you guys very much for your time and attention. I really appreciate it. I'm going to take a quick 10-minute break, and we'll be back for session 2. If I didn't get to your question, I apologize. I tried to get to as many as possible. Please go ahead and review this. Session today, because FX Street has been nice enough to make it available, to record it and make it available for later download. We covered a lot of ground today. We actually covered most of the things I wanted to cover. What I want to say, we covered a lot of ground, so go ahead and review. You'll find a lot of little nuggets in there along the way that we covered. Just in the process of answering people's questions, I think I've hit on some of the most common reasons people lose. Greed and fear, not focusing, using too short a time frame, extra stress, over trading, picking the wrong direction, not reading their indicators correctly, using the wrong indicator in each situation, overextending themselves, trading with too large of a position, either for their account size or for their comfort level, trying to live from trading when they don't even have enough to trade mini accounts effectively. These are the most common reasons when I did a brainstorm from my past students that I saw for losses affecting. And I think we've covered a lot of good ways to cover most of that. So go back and review, and I gave you guys the link to my website up there, fxknight.com. Okay? Don't be afraid to drop by, sign up for my mailing list, visit the chat room and say hello. Check out the forum, see if we have an article that addresses the issue you're encountering. And if not, ask a question. Maybe we can write an article to address an issue you're encountering. Or if you're one of the 4s and 5s and you're a real brainiac out there, why not contribute an article? Do your fair share. Help the newbies out. I firmly believe that if you really want to improve your winnings, then A, contribute to charity, and B, find some people that are new and help them out. Those are the fastest ways I know of to improve your success. Seriously, guys. So if you're one of the more experienced guys in here, drop by the forum and submit an article. Okay? Maybe it's something you've experienced recurring losses in and you just found a great tip for countering them. We'd love to have your input and insights, and we hope to see you again.